This week for Supermicro Computer, record-breaking revenue clashed with a significant squeeze on profits. After a sharp drop last week, the stock saw a flurry of bullish options activity, raising the question, is this a genuine growth story or a value trap? With sales more than doubling year over year, why are investors so focused on shrinking margins and a long-vacant executive chair? Welcome to TickerWatch News for Supermicro Computer, Week 8, 2026. This episode examines the news and market developments for the AI server maker as investors digest a blockbuster yet complicated quarterly earnings report. Stock Snapshot. It was a volatile week for Supermicro Computer. The stock experienced significant selling pressure, closing the prior week down around 11%. The sell-off came as investors weighed record-setting revenue against concerns over profitability. However, the narrative saw a shift in recent days. Trading volume on Friday surged to over 42 million shares, roughly 47% above the three-month average. This was accompanied by a spike in bullish call option buying, which helped the stock price reclaim its 50-day moving average, a key technical indicator for momentum. The takeaway is a stock caught between two narratives, explosive growth and shrinking profitability, leading to sharp swings in investor sentiment. Top news and headlines. The biggest story for Supermicro was its recent second-quarter earnings report, which continues to ripple through the market. The company announced quarterly revenue of $12.68 billion, a stunning 123% increase from the same period last year, which handily beat analyst expectations. Following this performance, the company raised its full-year revenue guidance to a minimum of $40 billion. However, the celebration of this top-line growth was muted by a sharp focus on profitability. The company's gross margin fell to 6.3% from 11.8% a year ago. Management attributed this compression to several factors, including the costs of scaling up new platforms, higher logistics expenses, and a product mix tilted towards large hyperscale customers who command greater pricing power. This leads to another major headline: customer concentration. It was reported that a single data center customer was responsible for approximately 63% of total revenue in the quarter. Such heavy reliance on one client presents a significant risk for the company's future financial stability. Finally, adding a layer of corporate governance concern, a Fortune report this week pointed out that Supermicro has yet to appoint a new permanent chief financial officer. This comes more than 14 months after the company stated it would immediately begin a search to replace the current CFO, David Wygand, following the recommendations of a special investigation. The delay in filling this crucial role has raised questions for some investors. Market reaction and investor sentiment. The market's reaction has been decidedly mixed. On Wall Street, the analyst consensus is a moderate buy, with an average price target of about $43. This suggests analysts on average see a potential upside of around 35% from recent levels. However, this consensus masks a deep division. Some firms, like Rosenblatt, reiterated a buy rating, while Goldman Sachs maintained its sell rating, highlighting the structural challenges to profitability. Despite the split among analysts, sentiment among some traders turned bullish this week. A surge in call option buying was observed, with the ratio of puts to calls dropping to 0.16, well below its 20-day average. This indicates a strong short-term belief in the stock's upward potential. Adding another dimension to the sentiment, several company executives showed confidence through their actions. In early February, filings revealed that CEO Charles Lang and CFO David Wygand, along with other insiders, purchased shares at an average price of around $33.33. Technical and fundamental check-in. From a technical perspective, the stock's ability to reclaim its 50-day moving average this week is a positive signal for momentum-focused investors. Still, the bigger picture shows a stock that remains down approximately 45% from its October high. The The 14-day Relative Strength Index, or RSI, is at a neutral level of 51, suggesting that the recent bullish run isn't overextended and could have more room to move. On the fundamental side, the view is complex. The bull case points to a company trading at an attractive valuation for its central role in the artificial intelligence build-out. Its forward price-to-earnings multiple is under 17, and its price-to-sales ratio is more favorable than some peers. The staggering revenue growth and increased full-year guidance support this optimistic outlook. The fundamental risk, however, is substantial. Profitability is the main concern. The company's 6-month net income was actually lower than the same period a year ago, despite the massive increase in sales. A net income margin of just over 3% indicates the company is keeping very little of its revenue as profit. This, combined with the high customer concentration and the unresolved CFO search, creates a challenging risk profile. What to watch next week? Looking ahead, Supermicro is scheduled to participate in several investor conferences in early March, including events hosted by Morgan Stanley, KeyBank, and Loop Capital Markets. These events could provide further insight into the company's strategy for addressing margin pressures and diversifying its customer base. Technically, investors will monitor whether the stock can maintain its position above the 50-day moving average and use it as a new level of support for further gains. This sets up clear scenarios for the near future. The bull case is that margin pressure is a temporary strategic choice to capture market share in large-scale AI deployments, and that profitability will improve as the company scales its higher-margin data center building block solutions. If this proves to be true, the stock could be significantly undervalued. The bear case is that the profit compression is structural, leaving Supermicro squeezed between powerful suppliers and customers with no clear path to better margins. In this scenario, the high customer concentration and governance overhang could weigh heavily on the stock. The most likely base case is continued volatility, as the market looks for a clear signal on whether revenue growth can translate into sustainable profit growth. Thank you for tuning in to TickerWatch. This podcast is for informational and educational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional. We encourage you to subscribe, leave a review, and share this episode.